I have a good idea of price action and how to interpret them. So I used to think that maybe this is what I have been missing. I mean, the holy grail to my strategy as a trader. So I just do some analysis to get the odds in my favor so that I can get the best out of the opportunity that price action gives me. For example, I can wait, of course, for some price action that signals a reversal and wait for the confirmation of that reversal and place my trade hoping to make a killing in the market. Now, looking at this thinking or analysis, it is absolutely valid. But let's be realistic. I made it valid, not the market. What I needed to do was to find how the market validates a price action and then follow through on that price action. Here's what I mean. We've all been told about how a hammer or shooting star acts as reversal pattern for uptrend and downtrend respectively. Why then do the trend tends to continue even when this pattern forms? This became a question I asked, searched, and finally found an answer to. So, for the rest part of this video, I'll be showing you the reason this pattern tends not to do what we've all been told they do. And not only that, I will show you the thinking process I used in order to come up with a strategy for this failed pattern. To be honest, it seems like this pattern tends to betray our expectation for reversal. The thing is, the pattern works and the appearance is valid, but the participants in the market have a very strong belief about the continuation of the trend. In other words, they are ready to back up their belief about future price movements with the money they have, even to the extent that no valid pattern will be respected. So, when I noticed this, I decided to call it the failure strategy because 9 times out of 10, when a reversal pattern happens in a trend, but then fails to reverse as expected, then the next candle will continue the trend. With this in mind, I had to come up with a good way to take full advantage of this. First, for me to be able to identify the failure strategy happening in real time, I had to put the odds in my favor. So this was my plan for action. Something that would make me spot this setup probably before it happens so that I will be well prepared to take advantage of it. My first thought was the dominant trend. I had to find the dominant trend first so that I have an idea where to look for a failure to occur. Clearly, if I don't find the dominant trend, it means I will be trading against it, and that's going to lead to many bad decisions. Next, I have to look for a good, strong key level. I had ideas about key levels like fair value gap, order blocks, round numbers, support and resistance, EMAs and Bollinger Bands, Fibonacci level, just to mention a few. But the truth is, not all of these levels are needed. Not all will work with the failure strategy, so I decided to go with those that have shown the highest probability of success when used. I choose the round number, support and resistance, and the Fibonacci levels. With this acting as key level and a dominant trend, I have been able to shift some of the probability of success to my favor. Now, I need a price action pattern that suggests a reversal, something like a hammer or a shooting star in a downtrend and uptrend respectively. Other patterns like shaving head candlestick stopping at a key level, or a candle with a wick going over the key level and closing price stopping at the key level, all of these suggest a reversal in price action. So now I know what I should be looking for after I identify the dominant trend and a good key level. A reversal pattern that fails to deliver what is expected of it. Here's how I thought about it. If I see a shooting star in an uptrend forming at a resistance, I won't go into the reversal trade. I will wait for the next candle to close above the resistance. When this happens, I will simply use the resistance as a support and place a call trade. But this is 1 minute expiration, therefore I had to be careful not to enter too far away from the entry price. This poses a concern for me because in the past I have ended up losing trades even though the direction of the trade were correct. But because the candlestick sometimes moves too fast, I get the wrong entry point. I thought of a way I could solve this problem and then I came up with some solutions and I'll definitely share them with you guys. But before I do, just a quick reminder that if you haven't, please do well to like and share this video and also subscribe to the channel for more informative content like this. So let's get back to how I solve the problem of wrong entry points. Whenever I get into trade, sometimes I get the exact entry point and other times I completely get it wrong. Then at the end of the trade, whenever I get it wrong, I may find out that I got the analysis right, but the entry point was just not good enough. So after much thought, I came up with 3 different ways to get the trade with a better entry point. First is placing the trade above or below the closing price of the previous candle. If it's a bullish candle and an upward trade, I'll do a call trade below the closing price, and if it is a bearish candle and a downward trade, I'll place the put trade above the closing price. This way, I know if I get it below the closing price, there will be a margin of safety in the case where the next expected candle ends as a weak candle. The next method was to trade below strong key levels where the price action took place. For example, if there is a breakout of a resistance level and the next candle goes back down towards the previous resistance, now acting as support, I would place a trade when the running candle goes below the resistance turned support level. This way, I have the opportunity to benefit from the pressure that the market participants will add to the market below the support level. I won't have to fight for a good price to buy from. Lastly, I'll wait for the price to move towards my desired direction, taking advantage of market volatility. This way, the price swings backward and forward. I will enter the trade when the price moves back to the safe entry point, because if I had entered immediately, then volatility may have given me a wrong entry point. This becomes the method I use to eliminate bad entry for my trades. Now that we learned by theory how to trade the failure strategy, you need to remember that self-control and discipline in trading is a very practical thing, which I'll be talking about shortly. But before then, let's look at some example of the failure strategy so that we can understand better how the failure strategy works.
Now, in this example, we have a downtrend. Now, this downtrend is being put in pressure by a dark cloud cover, which is forming at a round number. Now, after the dark cloud cover candlestick pattern, we see a red candle with a lower wick at the bottom. Now, this lower wick at the bottom is happening at a low, and this low is acting as also a support level. Now, looking at this, you are expecting that the next candle should be a green candle because it has a rejection from the support level. But what we saw was a breakout from that level, and this is what failure is. For the candle not to have reversed, it means that it failed to reverse, and that failure is going to add selling pressure to the market. So all I need to do was to continue the downtrend instead of going for a reversal, because it is more safer to follow the flow of the trend. And this is how the failure strategy happens in this downtrend. Now, since we've known how to do this in a downtrend, let's look at how it happens in an uptrend. Now, this example is for an uptrend. Now, as you can see, we have a gravestone doji, or you can say a shooting star candlestick pattern. But look at what happened next. Instead of the shooting star candle to produce another red candle, it went ahead to produce a green candlestick pattern. So this is failure. But now, one thing about this trade in particular is where I entered the trade from. I did not just enter the trade from the closing price of the previous candle. I had to wait for the candlestick to come back down to the opening price of the candle, because the candle might end up closing as a red candle. So I needed the margin of safety to get me a safe entry point. Why? Because this candle is closing outside of the 2 deviation Bollinger Band, which may bring in selling pressure. So with that in mind, I had to wait for the selling pressure to be exhausted, and it was exhausted at the closing price or below the closing price of the previous candle. And when I got that safe entry point, I did my trade there, hoping that the market is going to close in my favor, and which of course it was very close, but at last it closed in my favor. So we've seen how we can use the below the closing price and opening price as good entry point. Now, the last candlestick, I'm using the key level as an entry point. Now, before now, we can see that we had what? An engulfing candlestick in this chart pattern, and after that engulfing candlestick, we saw a 2 candle breakout. Now, after the 2 candlestick breakout, we are supposed to enter into the core trade. Now, looking at this chart, as I'm zooming out, I see no reference point to use. The only reference point is the support and resistance level. So I'm using that, or below the closing price, to do a trade, and I got that in the morning as well. So the Telegram Signal group is now running, and the people who have subscribed to the Signal group are earning money already. So the earlier you start, the better for you. So that will be all for now. If this is your first time, do well to like, share, and subscribe to the channel. So that will be all for now. I thank you for listening up to the end. If you keep on practicing this strategy that I just shown you, you will find out that there will be a visible improvement in your trading. I will be sharing more of these strategies later in the future. So until next time, bye bye.